What if the biggest problem for the US economy right now is not inflation, but the possibility that the labor market is quietly losing momentum faster than Wall Street expected? Because the latest July jobs report has delivered exactly that warning. The US economy unexpectedly lost jobs in July, while expectations had been pointing toward another month of employment growth. And suddenly the market is looking at the Federal Reserve very differently. The rate hike narrative that had been building around persistent inflation is now facing a serious challenge from a weakening labor market. And this is where things become extremely important for gold, and especially silver. Because when employment weakens, investors immediately start asking one question: can the Federal Reserve really keep policy restrictive if the labor market is deteriorating? If the answer is no, then Treasury yields can come under pressure, the dollar can lose some support, and precious metals can suddenly become much more attractive. But there is a second side to this story. Global food prices are also moving higher, with heat waves, wars, supply disruptions, and higher crop costs creating renewed inflation pressure. So the Fed is potentially facing a very uncomfortable combination: weaker employment on one side and stubborn inflation pressure on the other. That is the contradiction we need to understand. Welcome back to Macro Bullion. I'm Alex James, an independent macro and precious metals analyst, and today we are breaking down one of the most important economic developments for gold, silver, and the US dollar. The latest US employment data is not simply another monthly jobs number. Markets are interpreting it as a possible signal that the labor market is becoming less resilient than previously believed. According to the latest Reuters report, U.S. non-farm payrolls declined by 23,000 in July, a major disappointment compared with expectations for an increase. At the same time, the unemployment rate eased to 4.1%. Now, that combination deserves attention. Now, this is where the July jobs report becomes much more important than the headline itself, because the real story is not simply that the U.S. economy lost jobs. The real story is what this weakness could mean for Federal Reserve policy, Treasury yields, the dollar, and ultimately the precious metals market. For months, the market has been trying to answer a difficult question: is inflation the bigger threat, or is slowing economic growth becoming the bigger threat? The latest employment data pushes that question directly back into focus. A labor market does not usually go from strong to weak overnight. The deterioration tends to appear through several smaller signals first. Hiring slows, employers become more cautious, job openings decline, payroll growth becomes less reliable. Previous numbers are revised. Eventually, the headline employment data begins to reflect the underlying slowdown. That is why revisions matter so much. If earlier employment gains were stronger than they ultimately turn out to be, investors can mistakenly believe that the economy has more momentum than it actually does. Once those figures are revised lower, the entire picture changes. Suddenly, what looked like a temporary slowdown can begin to look like a broader trend. And that matters enormously for the Federal Reserve. The Fed has two major responsibilities: maintaining price stability and supporting maximum employment. Those objectives can work together when the economy is healthy and inflation is under control. But when inflation remains uncomfortable while employment begins weakening, monetary policy becomes much harder. Imagine the Fed has been keeping interest rates restrictive because inflation remains above its preferred level. Then suddenly the labor market begins losing momentum. If policymakers keep rates high for too long, they risk pushing the economy into a deeper slowdown. But if they cut rates too quickly while inflation remains elevated, they risk allowing price pressures to become entrenched again. That is the policy trap. And markets are already beginning to adjust their expectations around that possibility. This is particularly important because interest rate expectations influence precious metals through several channels. When markets expect higher rates for longer, Treasury yields tend to receive support, and the dollar can also benefit. Higher yields increase the opportunity cost of holding assets such as gold and silver because precious metals do not generate interest income. But when expectations shift toward lower rates, that equation can change. Falling yields reduce the opportunity cost of holding precious metals. A weaker dollar can make dollar-priced commodities more attractive to international buyers, and uncertainty around economic growth can increase demand for defensive assets. That combination can create a powerful environment for gold. But silver deserves a separate discussion. Silver is not simply a smaller version of gold. It has monetary characteristics, but it is also heavily connected to industrial activity. Silver is used across electronics, solar technology, electrical applications, and other industrial processes. That dual identity creates both opportunity and risk. If the Fed becomes more supportive because economic growth is slowing, the monetary side of silver can benefit. But if the slowdown becomes severe enough to damage industrial demand, the industrial side can become a headwind. So the most bullish environment for silver may not be a deep recession. It may instead be a period where growth slows enough to push monetary policy expectations toward easing, while industrial demand remains reasonably resilient. That is a much more specific scenario. And this is why I would not interpret the July employment report in isolation. We need to watch what happens next. If future employment reports continue to disappoint, the market could begin pricing a much greater probability of rate cuts. If inflation simultaneously remains elevated, however, the Fed may move more cautiously. That could create significant volatility in Treasury yields and the dollar. And volatility is important because precious metals often react not only to the absolute level of interest rates, but also to the speed and direction of changes in expectations. Think about the sequence. Weak employment data appears. Markets reduce expectations for aggressive monetary tightening. Treasury yields come under pressure. The dollar loses some support. Real yields potentially decline. Gold benefits. Then investors begin looking at silver. If silver is already showing strong momentum and industrial demand remains stable, capital can rotate into the higher beta precious metal. That is where silver can potentially outperform gold during a strong precious metals advance. But there is another major factor we cannot ignore: inflation. The global food price story creates an important complication. Heat waves, geopolitical conflicts, and crop disruptions can raise food costs. Energy and transportation disruptions can also feed through to consumer prices. The problem for central banks is that supply-driven inflation is extremely difficult to control with interest rates. Higher interest rates cannot make a drought disappear. They cannot immediately rebuild damaged crops. They cannot instantly remove geopolitical disruptions from global supply chains. What higher rates can do is weaken demand, and that creates another difficult trade-off. If policymakers respond aggressively to inflation caused by supply disruptions, they could weaken economic activity without necessarily eliminating the original source of inflation. That is why the combination of weak employment and elevated inflation is so uncomfortable. It creates the possibility of what markets often fear most: stagflationary pressure. Now, I am not saying the US economy is automatically entering stagflation. That conclusion would be premature. But the ingredients are worth monitoring. Weak employment tells us that growth and labor demand may be losing momentum. Higher food prices tell us that inflation risks have not disappeared. And if both trends continue, the Fed's policy choices become increasingly complicated. For silver investors, this creates a very interesting setup. In a pure growth slowdown, silver could face pressure from weaker industrial demand. In a pure inflation environment, silver could receive support from its monetary and commodity characteristics. But in a mixed environment where inflation stays elevated while markets increasingly expect monetary easing, precious metals can attract significant attention. Gold would typically be the first defensive asset investors look toward. Silver could then become the higher volatility expression of the same macro theme. And that is why I believe the next stage of this market should not be judged by one headline price move. We need to watch the relationship between silver, gold, the dollar, and treasury yields. If gold continues to hold firm while yields decline and the dollar weakens, that would provide an important confirmation signal. If silver then begins outperforming gold, it could suggest that investors are becoming more comfortable taking risk within the precious metals sector. But if yields rise sharply, the dollar strengthens, and economic data deteriorates at the same time, silver could struggle because the market would be pricing both tighter financial conditions and weaker industrial demand. So there are two very different paths developing. One path leads toward easier monetary policy and potentially stronger precious metals demand. The other leads toward higher real yields, a stronger dollar, and pressure on industrial commodities. The next few economic reports will help determine which path becomes dominant. And this is why today's jobs report may be remembered not because of the headline number itself, but because it could mark the moment when the market began questioning whether the US economy is still strong enough to justify restrictive monetary policy. The Federal Reserve now has a much more complicated equation to solve. And for gold and silver, that equation could become the catalyst for the next major move. Now, let's take this one step deeper, because the most important question for silver is no longer simply whether the US jobs market is weakening. The bigger question is what happens to the dollar, treasury yields, and investor expectations if that weakness continues. This is where macro markets can become very deceptive. A weak jobs report sounds immediately bullish for precious metals because investors assume the Federal Reserve will cut rates. But markets do not trade on headlines alone. They trade on expectations, positioning, inflation, and what investors believe the central bank will do next. And that distinction could determine whether silver simply consolidates or begins another major move. Let's start with Treasury yields. When investors believe the economy is strong and the Federal Reserve needs to maintain restrictive policy, Treasury yields can remain elevated. Higher yields increase the attractiveness of interest-bearing assets and can put pressure on precious metals. But when employment data deteriorates, investors can start anticipating weaker economic growth and a more accommodative Federal Reserve. That can push yields lower, and lower yields can change the opportunity cost of holding gold and silver. This relationship is particularly important when we look at real yields, the return investors receive from government bonds after accounting for inflation expectations. If real yields decline, the relative attractiveness of non-yielding assets such as gold and silver can improve. This does not mean precious metals automatically rise every time yields fall. Markets are more complicated than that, but a sustained decline in yields combined with a weaker dollar would create a much more supportive macro backdrop. And the dollar is the second piece of this puzzle. Gold and silver are globally traded commodities, but they are priced in US dollars. When the dollar strengthens, dollar-priced commodities can become more expensive for buyers using other currencies. When the dollar weakens, the opposite can happen. This means a weaker US labor market can indirectly become important for silver through the currency market. Suppose investors conclude that the Fed will eventually need to ease policy. Rate expectations move lower, Treasury yields decline. The dollar loses some of its interest rate advantage. Suddenly, precious metals have another source of support. And this is where silver can become especially interesting. Silver has historically shown greater volatility than gold. When investor confidence in the precious metals trend increases, silver can sometimes move faster because its market is smaller and because it combines monetary demand with industrial demand. But higher volatility works both ways. If the macro setup changes, silver can also fall faster. That is why I would pay close attention to the gold-silver relationship. If gold begins strengthening while silver remains weak, the market may still be operating in a defensive mode where investors prefer the traditional monetary hedge. But if gold remains strong and silver begins catching up or outperforming, that can signal a broader risk appetite developing inside the precious metals sector. And that could become one of the most important signals to watch during the next phase. Now let's bring the US consumer into this equation. Employment is not just a statistic for economists. Jobs generate income. Income supports spending. Spending supports business revenue. Business revenue supports hiring. That creates a feedback loop. When the labor market weakens, consumer confidence can eventually weaken as well. If households become more cautious, spending can slow. If spending slows significantly, businesses can become even more cautious about hiring. That is why labor market deterioration can sometimes become self-reinforcing. However, we are not at the point where one weak report proves that this cycle is already underway. That distinction is critical. A single month of weak employment does not establish a recession, but when weak payroll growth is combined with downward revisions, softer economic activity, cautious consumers, and other signs of slowing demand, the probability of a broader slowdown becomes more important, and markets will be watching exactly that. Now consider the inflation side again. Food prices moving higher create a completely different problem. If households are paying more for essential goods, they have less disposable income available for discretionary spending, so higher food prices can actually weaken consumption while simultaneously keeping headline inflation elevated. That is a particularly uncomfortable combination. The consumer feels pressure, businesses face higher costs, the central bank sees inflation, and financial markets start questioning how long restrictive monetary policy can continue. This is why the next few months could become extremely important. If inflation pressures begin easing while employment remains weak, the Fed could gain more room to support the economy. That would be a potentially powerful bullish signal for precious metals. But if inflation remains stubborn, the Fed may be forced to move more slowly, and that could create a period of extreme volatility rather than a straight-line rally. For silver, volatility may actually be part of the story. Investors sometimes expect silver to move in a clean upward trend once the macro fundamentals become bullish. That is rarely how the market behaves. Silver can experience sharp rallies, sudden pullbacks, consolidation periods, and violent reactions to changes in the dollar or interest rates. So the question is not whether silver can be volatile, the question is whether the broader trend is becoming increasingly supportive. And right now, one of the biggest developments to monitor is the shift in interest rate expectations. The market had previously been concerned about persistent inflation and the possibility that the Fed might need to keep policy restrictive for longer. But a major downside surprise in employment challenges that assumption. If subsequent data confirms the slowdown, the market may begin moving from a higher rates for longer mindset toward an eventual easing mindset. That transition can be extremely important for precious metals because markets often move before the Federal Reserve actually changes policy. Investors do not wait for the first rate cut to start repositioning. They anticipate it. That is why silver can move well before an actual policy decision. The same applies to gold. Precious metals are forward-looking markets. They are constantly trying to price what the economic environment could look like several months from now. So, if investors increasingly believe that the labor market is weakening and the Fed will eventually respond, the market could begin pricing that outcome long before policymakers formally announce a major policy shift. But here is the warning. We should not automatically assume that every weak economic number is bullish. If the economy deteriorates too quickly, industrial commodities can come under pressure. Silver is particularly sensitive because of its industrial component. A serious global slowdown could reduce demand from manufacturing, electronics, construction, and other industrial sectors. That could offset some of the monetary policy support. This creates what I would call the silver balancing act. On one side, lower rates, lower yields, potentially weaker dollar, higher safe haven demand, potentially bullish. On the other side, slower economic growth, potentially weaker industrial demand, risk-off positioning, potentially bearish. The winning side will depend on the severity and speed of the economic slowdown. If the U.S. economy simply cools while inflation gradually moderates, that could be an ideal environment for silver. If the economy enters a much deeper contraction, silver could initially struggle before monetary stimulus becomes powerful enough to dominate the industrial weakness. That distinction is extremely important for anyone analyzing the next major silver move. And this is where I want to bring everything together. The July jobs shock has changed the conversation. We are no longer looking only at inflation. We are now looking at the possibility of a labor market slowdown occurring at the same time that global food price pressures are increasing. That means the Federal Reserve may face a much more complicated policy environment. And when central bank policy becomes uncertain, market volatility usually increases. For gold, that uncertainty can create defensive demand. For silver, it creates a high-risk, high-opportunity environment. The next confirmation will come from the dollar and treasury yields. If yields begin trending lower and the dollar loses momentum while silver holds its ground, that would be an important signal that investors are positioning for easier financial conditions. But if yields remain elevated and the dollar strengthens despite weak employment data, it would tell us that inflation concerns are still dominating the market. And that is the signal we need to watch before making any aggressive conclusion about silver's next move. Because the next major silver rally may not begin with a dramatic headline. It could begin quietly, with falling yields, changing Fed expectations, a weaker dollar, and investors gradually realizing that the monetary environment is shifting underneath the surface. Sure. And if that shift accelerates, silver could become one of the most closely watched assets in the entire commodities market. Now we reach the part of the story where the macro signals start connecting into one larger picture, because the question is no longer whether the July employment report was weak. We already know it was a major downside surprise. The real question is what the Federal Reserve, the bond market, and investors do with that information from here. And this is where I believe the next few economic reports could become more important than the July number itself. One weak employment report can be dismissed as temporary. 2 or 3 consecutive signs of deterioration are much harder to ignore. That is why the next labor market data will be critical. Investors will want to know whether July was simply an isolated disappointment or whether the weakness reflects a broader cooling in hiring. If the weakness continues, the market could begin aggressively reassessing the path of monetary policy. Remember, monetary policy works with a delay. The Federal Reserve changes interest rates today, but the full economic impact can take months to appear. That means policymakers are constantly trying to look ahead. If the labor market is weakening now, the Fed has to consider what the economy could look like several months from now. This creates a difficult timing problem. If policymakers wait until economic weakness becomes obvious everywhere, they may already be too late. But if they ease too early and inflation remains persistent, they could risk reigniting price pressures. That is why central bank communication will become extremely important. Every comment from Federal Reserve officials can influence market expectations. If officials emphasize inflation risks, Treasury yields could remain elevated. If officials increasingly emphasize employment risks, markets could begin pricing easier policy, and precious metals will respond to that shift long before any formal policy decision is actually made. This is particularly important for silver because silver is effectively sitting between two major macro forces. The first is monetary, the second is industrial. On the monetary side, a more accommodative Federal Reserve could support silver through lower yields, weaker dollar expectations, and stronger investment demand. On the industrial side, the outlook depends heavily on economic growth. If the U.S. economy slows modestly while global industrial activity remains healthy, silver could benefit from both sides. But if the slowdown becomes severe across major economies, industrial demand could become a significant headwind. This is why I do not want to give you a simplistic "jobs are weak, therefore silver must rise" argument. That would be incomplete analysis. Instead, we need to identify the conditions that would confirm the bullish case. The first confirmation would be a sustained decline in Treasury yields. The second would be a softer U.S. dollar. The third would be evidence that markets are increasing expectations for monetary easing. And the fourth would be silver showing relative strength compared with gold. If those four conditions begin appearing together, the probability of a larger precious metals move increases. Now let's talk about gold for a moment. Gold often acts as the first destination for investors looking for protection against monetary uncertainty, geopolitical risk, and financial instability. Silver tends to follow later when investor confidence in the precious metals trend becomes stronger. That creates an interesting potential sequence. Gold moves first. Investors become convinced that the macro environment is becoming more supportive. Silver begins catching up. Momentum traders and commodity investors enter the market. Silver's relatively high volatility amplifies the move. That does not guarantee a rally, but it explains why silver can sometimes outperform gold during strong precious metal cycles. And this is where current inflation concerns become particularly interesting. Global food prices are rising as extreme weather, geopolitical conflicts, and crop disruptions put pressure on agricultural markets. That creates an inflationary background that central banks cannot easily control. If these pressures remain temporary, the Fed may look through them. But if higher food and energy costs begin spreading into broader inflation expectations, policymakers could become much more cautious. And that could keep real yields higher for longer. This is the main risk to the bullish precious metals thesis, because precious metals do not exist in a vacuum. If inflation expectations rise faster than nominal yields, real yields could potentially remain under pressure, which can support precious metals. But if nominal yields rise sharply as markets demand greater compensation for inflation, the effect becomes much more complicated. The dollar could strengthen, financial conditions could tighten, precious metals could face volatility. That is why investors need to watch the bond market rather than simply watching the inflation headline. The bond market is effectively telling us how investors are pricing the future. And right now, the most important question is whether investors believe the Fed's bigger problem will eventually become unemployment or inflation. If the market moves toward unemployment, rate cut expectations can strengthen. If the market moves back toward inflation, rate cut expectations can weaken. Silver could react violently to that change. There is another factor that deserves attention: mortgage rates. Mortgage rates have recently moved higher for a fifth consecutive week, reaching levels not seen since 2025 for a second consecutive week. That matters because housing is one of the most interest rate sensitive parts of the economy. Higher mortgage rates increase the cost of financing a home. That can reduce housing affordability, it can slow transactions, it can affect construction activity, and over time it can influence consumer spending and broader economic confidence. So we have to look at the economy as a connected system. Employment affects income, income affects spending, interest rates affect borrowing, borrowing affects housing and investment, inflation affects purchasing power, and all of these factors eventually feed back into Federal Reserve policy. That is why a single employment report can have such a large impact on financial markets. It changes the assumptions behind the entire economic model. Now let's consider the broader global picture. Canada's strong July employment report shows that not every economy is moving in the same direction. That is important because investors sometimes make the mistake of treating global economic conditions as one synchronized trend. They are not. Different countries have different inflation rates, labor markets, currencies, fiscal policies, and central bank strategies. But the United States remains uniquely important because of the dollar's global role and the size of U.S. financial markets. If U.S. monetary policy begins shifting toward easier conditions, the consequences can spread internationally. Capital flows can change, currency markets can move, commodity demand expectations can change, and precious metals can respond. This is why silver investors should be watching more than just the silver chart. Watch the dollar, watch treasury yields, watch gold.